We're really trying to bring across the message that both active and passive investment strategies have merit. One is not superior to the other when altered for a number of factors. And the most important thing is, in the context of the investment climates, keeping costs down and remaining fully invested are probably the two key things that lay investors should understand will be the main drivers of the investment strategy over long periods of time. We have various factors that are affecting us that are unnecessary in some respects, and I mean obviously the political developments have been well documented, but that's also, we need to understand that valuations are quite stretched in many asset classes. Globally, the normalization of interest rates is something that has to happen at some point in time, and this creates risk for interest rate sensitive securities all around the world. So things are challenged, and one has to be very circumspect about how one invests and making sure that the companies and the strategies you invest in will be around in 10 years' time. I think that's the key thing one needs to consider right now. So the risks, in our opinion, would be very much in securities that don't pay investors any income, where there's a large reliance on the price appreciation, on capital returns to deliver the investment outcome to the investor. We strongly believe that companies and securities that pay regular and growing income distributions through dividends or property distributions are likely to endure this environment better than others that are purely reliant on price appreciation. So that's really the challenge, and the opportunity is that there are for active managers, good stock pickers, there are still opportunities out there that can still deliver above inflation returns, and I guess that's really the minimum hurdle that we'd expect for our investors. We first of all need to start making not just the right noises, but actually following up those noises with proper policy. We need to stop the bleeding of the national coffers. We need to make sure that the taxpayer is not increasingly funding a dysfunctional fiscus. And once we get those basic things right, there will be more money to go around. We will have more money for projects, and the multiplier effect will start to kick in. Confidence is lacking. We need confidence to return to this market.